Welcome to another episode of Millennial Investing Explained. Here's today's question. In your current startup, Boon, you've been able to run a successful capital raising campaign in an area that is relatively new in comparison to other funding avenues that are available. Can you talk to us about your experience using equity crowdfunding to help get Boon off the ground?
Absolutely. So having been in a number of startups and having worked with venture capital and angels and things over time, I brought this idea of equity crowdfunding to them. And so I really started talking to them. No, this is really like an initial private offering of your stock that you can give and sell just like it was on the publicly traded market, except it's private. And thanks to the Jobs Act in 2016, it actually made it legal for just about anyone to be able to invest, whereas before you had to be an accredited investor, which was $250,000 in annual income for the last several years or $1 million net worth, excluding your primary residence. So if you look at America, there's a very small subset of people who have that ability to invest in startups. So 2016 rolled around, Jobs Act came, and then a lot of professional investors gave there was just a lot of stigma associated with equity crowdfunding. Is that the fallback plan? Is that you went to all the angels and they said no? Did the VCs reject you? And so that I faced that stigma a lot, but I went to some people that I knew in the industry and that were investors, and I'm an investor myself. And I said, hey, I'm thinking about this and here's why. And so for Boon, our motto is practicing good and the idea of giving everyone an equal opportunity. And we wanted to do that with equity crowdfunding. So we partnered up with WeFunder. There's about 44. That number is also changing daily, but there's about 44 platforms that are approved by the SEC to be able to offer these initial private rounds. And it's just like investing, except you can invest as little as $100. And it really allows peers, it allows an industry to rally behind you and invest in your platform before you go to traditional angel money or even institutional money later on down the road. So it's been a unique journey. And I know we're going to talk about it a little bit more throughout this conversation, but that's really why I wanted to do it. I wanted to do something different. I'd raised money many other ways. And I was like, this is the right startup to give it a shot.
How is it different than Kickstarter?
So Kickstarter, you're giving away your money. If you put $100, you're going to get a t-shirt out of it. And if you're lucky, the restaurant that you put $100 in might open, or that brewery might open, and you might be able to drink a pint of beer there someday. Basically, we could go on Kickstarter in the next 2 minutes and start a campaign and just raise money. And that money you never see again. I think one of the best examples, and I don't have the numbers in front of me, but Oculus Rift was a Kickstarter. And I think they sold for like almost 1,000x 2 years later for what people invested. So if you put $100 into Oculus Rift when they were on Kickstarter, you would have got $100,000 2 years later. Unreal numbers. However, they were on Kickstarter. So guess who got that money? The founders. It was 100% owned by the founders. You weren't buying stock. You weren't buying securities. So with equity crowdfunding, you're buying stock just like you would in a publicly traded company. The difference is it's still a startup, so it's going to be much riskier. The stock isn't quite as fluid, so you can't buy and sell as you want, but you're actually investing. So when you put $100 in or 500 or 10,000, whatever number you want into something that's on equity crowdfunding, it's still an asset. It doesn't become a liability or a sunk cost. You actually get equity in that startup. And if that startup does well, you're going to make a lot of money.
So why would somebody as the founder want to go an equity crowdfunding route rather than Kickstarter? I mean, I get it from an investor's perspective. You definitely want to own a part of the company. You don't want to give your money away for free. But as the founder, why would you choose to give away part of the company when you could just go to Kickstarter and retain the whole company?
It's saying, hey, I'm not just doing a shot in the dark, kind of a flash in the pan startup or product. Because on Kickstarters, you see a lot of products and restaurants and movies. That's sort of, those aren't the only categories, but you do see those more. On something like WeFunder or Start Engine or Seed Invest, you're actually seeing people say, hey, I'm going to write that big check, and it's new deal flow. So if you are an investor, deal flow is sometimes hard and sometimes geographically limited by the angel network you're in and things like that. And so more and more professional investors are actually looking to some of these equity crowdfunding platforms for some of their big deals.
Now, can you get the same virality aspect of equity crowdfunding? I know like Kickstarter, you don't get equity, but a lot of times the founders can go that route because, maybe they're only getting $50, $100 from a person at a time, but there's so much virality behind that their products absolutely go viral and they raise 2x what they were looking. So Can you get that same aspect in an equity crowdfunding?
You absolutely can. And there's many campaigns who have done that. And you do see a lot of success in the beverage industry right now, particularly on equity crowdfunding. So I would definitely say going with Boon, which is a software, I would say almost borderline enterprise software company, and going the equity crowdfunding route, it was a bit more challenging than I would have hoped. However, for those more consumer products, equity crowdfunding, you're going to get that same virality that you're going to get with Kickstarter, but you get people that are invested in your company, and you never know if that person's also going to have deeper pockets that when you go to raise your Series A or whatever your next round looks like, they might come in, or the connections that they bring. Whereas someone invests in Kickstarter is really just looking for that one and done t-shirt, free bottle of beer, or whatever it might be.
You just never know who that investor is. You don't know who's in their network. They could bring a lot of money to the table. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.